for something other than what we've been seeing recently, I guess, to some degree. You see a defensive move in the markets in general, maybe a waning of this recovery trade, almost really a return to some of that disinflationary flavor we got used to in prior years. Lay that out for us.
Yeah, we look at the short term, just out to 6 months, the medium term, and then the long term in our reports. And this is a short-term call. We've had a big move since the COVID problems of 2020 in both cyclicals relative to defensives and value relative to growth. But I'm looking for a miniature deflationary shock, a stronger dollar, at least 5% pop in the dollar. The rolling over of the PMI manufacturing, which is that good old standby indicator that we use for so many things. And as that happens, it pushes you more into the defensives like healthcare, consumer staples, some of the utilities, and some of the telephones. It doesn't really argue for growth, because if we get the dollar shock on declining global liquidity, then the Goldman Sachs Financial Conditions Index will tighten. The PE multiple of the market will fall about 3 turns, and you'll get a up to 10% correction sometime between now and the end of October.
10% correction would be, in the context of this mini sort of deflationary shock. Now, would we presumably earnings estimates continue to race higher, because that has been, something that's actually made the market look cheaper now than it did at the beginning of the year, even though the S&P is up 14%.
Yeah, we did a note this morning, and we showed that our year-to-year growth estimates as you go out this year into 2022, I mean, historically, believe it or not, the PMI manufacturing index aligns with the year-to-year growth of S&P 500 earnings. And our estimates, which are below the street, we're at, I think, 37, 38% growth this year. The street's in the low 50s. Our estimates look more realistic based on the PMI forecast, and the PMI forecast is, of course, based on China's tightening with a lag. China is tightening, and the stronger dollar affecting us negatively.
Ed, how do you put this all together? I mean, against all of that, I mean, is the idea that, a strong uptrend in the first half tends to continue in the second. How would you play things through the summer here?
Yeah, I mean, Barry made some very, very good points. I'm not, however, in the correction camp. I think there's just way too much liquidity up there. I mean, M2 is up about $5 trillion compared to where it was early last year before the pandemic got started. So there's just an enormous amount of liquidity, which really reflects the fact that we've had a tremendous fiscal and monetary stimulus, and not all of that has actually been spent either in the economy or in the financial market. So look, we did have a correction in the Nasdaq earlier this year when bond yields got up to 1.7%. And then as the bond yields come back down to 1.5%, we've had another one of these rotations back into growth. But overall, I don't see a correction. I think it's going to continue to be a very broad-based market. I think that it's going higher. I've got 4,800 on the S&P 500 by the middle of next year. I don't want to talk about my forecast for this year because we're already there. I thought we'd get to 4,300 by the end of the year, and here it is mid-year, and we're just about there. So this market just keeps racing ahead of even the bullish scenarios.
Shepard Smith here. Thanks for watching CNBC on YouTube.